欢迎来到 PwC 的税务咖啡厅，我是主持人资诚联合会计师事务所的曾博生会计师。在这个快速变迁的世界里，税务政策不断演变，对每一个企业与个人都造成了深远的影响。我们的节目将为您带来最新的税务趋势、专家洞见与实务建议，让您在享受这杯咖啡的同时，轻松掌握税务世界的脉动。无论您是税务专业人士，还是对税务议题充满兴趣的听众，这里都有您需要的资讯和灵感。欢迎加入我们的讨论。好，那我们今天呢，录制一场非常特别的这个 podcast 啊，是我们第一次会用英文来做录制。好，那我们这一次呢，很高兴邀请到我们 PwC Global 国际税务的主持的合伙人Doug McHoney。那刚好他到台湾来，然后我就邀请他来参加我们这次的 podcast， 来谈现在这个美国啦，还有国际，还有台湾很多的这些税务上面的一些趋势跟改变。那我想等一下我们用英文的方式来进行，但是在过程间呢，我会协助我们的听众做一些简要的中文摘要，让大家可以跟上这一次 podcast 的内容。那我相信一定会非常精彩。So I think I'll switch to English, and it's really my honor to invite one of our distinguished guests, who is our global international tax service leader, who is also a U.S. tax partner, Doug McHoney, to join my podcast this time. So maybe Doug, I understand you are also a podcast host. And actually, we started our PwC Taiwan Tax podcast because of your podcast, Cross Border Tax Talk. So can you maybe say hi to our Taiwan listeners and maybe share some of your personal as well as the career background?
Yes, thank you very much. It's an honor to be here, Paulson. I will tell you it's a little less comfortable for me having the questions asked to me. I'm used to answering or asking the questions, not answering them. But it's a great honor to be on the podcast, to be able to have the opportunity to see what I'm seeing from a global international tax perspective. There's certainly a lot going on in the U.S. and a lot to talk about. But yeah, a little bit about myself. So I am the host of the Cross Border Tax Talks podcast. It is an English-only version of the podcast.
And I'm a frequent listener. I'm a big fan of your podcast.
Well, thank you. And we've been doing them for almost 7 years.
For sure.
I have, I think, almost 190 episodes under my belt at this point. And so when I started it, we were really the first international tax or really tax podcast that was out there. And it's fascinating how many people now get their information from podcast. And I think it makes a ton of sense that you did it here in Taiwan. It sounds like you have great listener base, and it's excited to be on. So a little bit about myself. I am a graduate from the University of Missouri, Columbia in the United States. I have an undergraduate degree in accounting, and I went to law school there as well, so a Juris Doctor. And I understand, Paulson, that we have that in common.
For sure. It's a big coincidence.
You have an MBA, right, from the University of Missouri, Columbia.
Yeah, the same campus.
So I'm a little bit older than you, so we didn't run into each other on campus.
But we are alumni.
We are both alumni and Missouri Tigers. And then also an interesting fact, Paulson, I'm actually a third generation Missouri Tiger. So my grandfather went to Mizzou. We call it Mizzou, as you know.
I think that happened a lot, right?
Yes,
I mean, I heard a lot of my classmates have legacy.
Yeah. So my grandfather went. Both my parents went. So my dad was a civil engineer. My mom was in education, and I was the first one to go into business. And then the first one to go to law school.
Right.
So I take a lot of pride in that, and I'm thrilled that you have an MBA from the University of Missouri. And so I've been at PwC for over 26 years, moved around quite a bit in the U.S., started in St. Louis and made partner in Cincinnati, and I was in Chicago for a while and Washington, D.C. I've been in the global role as our Global International Tax Services Leader for 3 years, and before that, I led our U.S. International Tax Services practice. And still very active serving clients, but now spend a lot of time focused on Pillar 2 and getting our network ready for Pillar 2. And the thing that I like to remind folks is that this is a major change management exercise for PwC
For sure.
for Pillar 2, just like it is a major change management exercise for our clients and taxpayers, and a major change management exercise for taxing administrators as well. So a lot of work that I've spent and our team has spent over the last 3 years really getting ready for Pillar 2.
Great. 那我想跟各位听众稍微说一下，这个 Doug 呢，其实在美国已经执业了超过20多年了。那一个特别的这个有趣的小故事，是我们两个在过去在大学的时候，其实读的是同一所大学，当然我们年纪不同所以没有在学校相遇不过这是一个蛮好的巧合那我想 Doug 呢这个针对 Pillar 2全球的很多动态有很多的经验。那我们等一下会请他来做一些深入的分享。Okay, so I guess we dive right into the topic. We wanted to talk about I think the global and also the U.S. Tax updates.
Sure.
And also, obviously, we want to hear a lot of your insights. So I think we start like from Pillar 2. I understand that, Doug, you've been traveling like over the world. Like you were in Taiwan. Last week we were both in Singapore. I understand you're traveling to Europe afterwards.
Right.
So you're hearing like, or observing like, global kind of movements on this legislation. And can you maybe share with our listeners any updates on the global developments about Pillar 2? And I think also particularly we all know that U.S. Did a very opposite thing for Pillar 2, where Trump administration kind of exit the Pillar 2 legislation. And I think we hear a lot of our clients asking about, okay, what does that mean for the global governments? Are they continuing Pillar 2 because if U.S. is not doing that? Mm-hmm. What would be the impact? Can you share some insights with us?
Yeah, maybe I'll start, Paulson, with one of the things that's been fascinating. I've been really focused on Pillar 2 since I took over the Global International Tax Services leader role. And what's interesting to me is as I travel to different countries and to different regions around the world, the challenges that taxpayers are having with Pillar 2 are very consistent. And as I travel to different countries, every country always thinks that when I'm talking to taxpayers and when I'm talking to our fellow partners that maybe they think they're behind, or one country they haven't done enough. And
yes.
It's all very, very consistent. And so far as the data challenges, the systems issues, the issues as we start thinking about compliance. And so maybe the first message for listeners is that everybody is having challenges with Pillar 2 and getting ready and effectively setting up this entire new set of books. And so the challenges that the Taiwanese taxpayers are facing are the same challenges that U.S. taxpayers are facing, same as European taxpayers. So it's very consistent by design. This is a global system of taxation. And we can come back to that, some of the practical issues, if you'd like, that we're seeing from taxpayers. But from a policy perspective, this is certainly what everybody wants to hear. So as I'm sure your listeners are familiar with, in January we have a new president in the United States, President Donald Trump. And what was fascinating, Paulson, on day one that he was in the White House, he issued an executive order, 2 executive orders, in fact, on international taxation.
Right.
And in my 26 years
We've
career,
never seen that before.
We've never seen such an interest in international tax.
For sure.
In fact, my mom, who's a educator, retired educator, asks me questions. Is this what you do? Do you know about this? But international tax is now in the news. It's on the front page of the major financial publications around the globe. And what Trump said in his day one executive orders is that the U.S. was withdrawing its support from Pillar 2. And he also mentioned that there would potentially be retaliatory provisions for countries that imposed Pillar 2 taxes on the U.S. And so let me unpack that and share a little bit about what that actually means. So first of all, when he says that the U.S. is repealing its support from Pillar 2, even before Trump was elected and sworn into the White House, the prospects of the U.S. actually enacting Pillar 2 were virtually zero. During the Biden administration, there was an attempt to conform our existing U.S. tax regime to Pillar 2 because we have a system called GILTI, which is Global Intangible Low Taxed Income, which effectively operates similarly to an income inclusion rule. Right. It requires a current inclusion. The rate of tax is effectively 13.125. And the Biden administration, when it committed to sign up for Pillar 2, it had planned to effectively change the GILTI regime to make it country by country and then increase the rate of which the U.S. multinationals
pay tax. To make it more like IR.
To make it more like an IR.
Right.
Now, it was on a different base still, right? It wasn't based on these financial accounting standards of the ultimate parent entity. It was U.S. taxable income. But as I know you're aware and some of your listeners may be aware, it was called the Build Back Better Act. Right. And then that failed. The Democrats were unable to get that through both chambers of Congress. It failed in the Senate and it didn't go anywhere. Well, at that point, the U.S. had already committed to Pillar 2. But those of us who follow this closely knew that, well, after the U.S. failed to conform GILTI to make it more like Pillar 2, that the U.S. was not going to enact Pillar 2 legislation, particularly using the model rules and commentary. Right. So point being, Trump's executive orders, we kind of knew, the U.S. was not going to be enacting Pillar 2. But what is most important, I think, and particularly for listeners from Taiwan and from other, outside the U.S., is that what Trump said during that executive order, that first of all, he did not want foreign countries taxing under Pillar 2 the U.S. tax base. Right now, there is something called the Undertax Profit Rule Safe Harbor, the UTPR Safe Harbor, that generally prevents foreign subsidiaries of the U.S. that are located in a jurisdiction that have enacted the Pillar 2 UTPR rules. It prevents them from taxing the U.S. base from the U.S. parent company. Right. That rule is effective until the end of 2025. I'll also note as an aside here that the U.S. corporate rate is 21%. Trump had said that he had hoped to move that down to 15%. We'll get into that, but I don't think that's going to happen. But the U.S. rate is 21%, and then we also have state taxes so that the effective rate is closer for most multinationals, somewhere around 25%. Right. But despite the fact that our statutory rates are relatively high, given the incentive regimes that we have in the U.S., including our non-refundable research and development credit, we have a number of other general business credits. We have elections where you can treat stock acquisitions as asset acquisitions, but there are a number of adjustments that can impact a U.S. multinational's Pillar 2 rate. And it is very common for a U.S. subsidiary of a foreign multinational or a U.S. parented group for their Pillar 2 rate to be below 15%, despite the fact that our rate is 25%. Yeah. So that is one of the reasons I think that Trump was very focused on in that executive order, saying that, well, anybody who tries to tax the U.S. parent group, that they view that as a discriminatory or extraterritorial tax on the U.S. could potentially be subject to retaliatory provisions. The other thing that he said in the executive order related to Pillar 2 was that he did not believe that foreign countries should also impose discriminatory taxes against foreign subsidiaries of U.S. multinationals. Right. That was sort of an additional step that we hadn't seen U.S. policymakers put out there. So generally, the U.S. is concerned that the CFCs of U.S. multinationals could also potentially be subject to tax under this undertax profit rule. And what he said in that executive order, that any discriminatory or extraterritorial taxes, he asked the Treasury Department, so who effectively works as part of the executive branch, to do a study and identify jurisdictions that have extraterritorial discriminatory taxes. And if there are jurisdictions, that he would impose something called Section 891. Okay. Now, this is a code section, Paulson, that has been in the Internal Revenue Code, so passed into law in the 1930s. In the 1930s.
Very, very old. 100 years old.
Over almost 100 years old. And I'll be honest, Paulson, as an international tax, trained attorney, practitioner, right, I never spent any time with Code Section 891. Many of us had to look this up and what is this and how does this operate? But effectively what it does is it allows the executive branch, the president, to effectively double the rate of taxes on citizens and corporations that are from jurisdictions that impose discriminatory or extraterritorial taxes.
Okay.
And generally that applies to individuals. It applies to corporations, so corporations doing business in the U.S. It applies to FDAP income, so fixed determinable annual periodic income, in other words, dividends, rents, royalties. And it effectively allows the U.S. to double the rate of tax on those individuals and corporations on actual income taxes as well as withholding taxes.
Right.
Now, the challenge with Section 891, it also applies to dual resident citizens and very draconian, very severe penalties for companies. There is a technical issue with 891 as well, to the extent that a treaty exists with the U.S. and one of those foreign countries. The way U.S. law works is that it's a later in time rule. So if a statute came out before a treaty, the treaty generally trumps, no pun intended, the treaty generally trumps the statute. Now,
yes.
I fully appreciate that we do not have a treaty between the U.S. and Taiwan, but
everybody has the hope that we would have a treaty.
And there are 60 countries that do have treaties.
Right.
And so under the way the U.S. law rule the U.S. law works, that generally treaties would, because they were all 60 plus of the treaties that we have in the U.S. were enacted or signed after Section 891 was enacted. But this was, I think, a big wake-up call for non-U.S. countries that have enacted Pillar 2 in 2024. There are 35 countries that have enacted the Pillar 2 rules. I think the UTPR, which is not effective until 2025, there are over 30 jurisdictions that have enacted a UTPR. So that countries that have a UTPR were very concerned that the Trump administration would impose Section 891. Well, since that executive order took place, their Treasury presumably had to issue this report to the president. We have not seen that list of the bad countries, so to speak, that have implemented whether discriminatory or extraterritorial taxes. But what has also happened since that executive order is that we know that we're going to get into this. There's U.S. tax reform that is going to happen this year. And there has been a proposed Section 899, which is a arguably more disciplined way to go after countries that impose a UTPR. That has been proposed as part of the One Big Beautiful Bill, and that is the technical name of the legislation.
That's over the front page of the newspaper.
Everywhere, globally,
everywhere,
right? And what Section 899 says, very similarly, if a country imposes discriminatory or extraterritorial taxes, and it really defines them more precisely as undertax profit rules, digital service taxes, or diverted profit taxes, then individuals and companies that are from those countries that impose those taxes, the withholding tax would go up by 5% per year until they repeal those particular discriminatory and extraterritorial taxes.
Right.
There are a couple of interesting provisions in there that also says that, well, the rate is intended, that 5% increase is intended to be supplemental to a treaty. So they've already thought about, it appears, like how this relates to those that we have treaties. Generally, the highest amount of tax is 20% more than the maximum rate. So for withholding taxes, for example, it would be a maximum of 50% withholding taxes. Again, it can only go up 5% per year.
Per year.
Another interesting part of the legislation was that it does say that if the undertax profit rule is turned off to the U.S. parented groups as well as foreign subsidiaries of U.S. multinationals, that even if a UTPR was still in effect in those countries, that it would have the effect of turning off Section 899.
Okay.
The reason that I mention that, Paulson, is that it helps establish that Congress, who's writing the rules, is in discussions with the Treasury Department, who is currently negotiating with the OECD to try to get an exemption or some sort of exception for U.S. multinationals under the undertax profit rule. And maybe the last thing that I will note is that We know that there are ongoing negotiations between the Trump administration, the Treasury Department, and the OECD. And so the OECD has to be very mindful that Section 899 is currently working its way through Congress. Obviously, they understand Section 891.
Right.
And so the U.S. does have pretty good negotiating power as far as trying to reciprocate, so to speak, against these undertax profit rules.
Right. Okay. But I think from Taiwan kind of company or even individual perspective, we probably can, I wouldn't say relax, but at least we currently don't have so-called UTPR rule in Taiwan. We don't have this digital service tax rule. And so hopefully that the U.S. will not put us in the list, and so there is no retaliation kind of measures against Taiwan. But I think this would really impact in other countries enacting their Pillar 2 rules.
Very much so. And I mean, it's interesting as you look around the world, there are a number of major economies that have not enacted Pillar 2, obviously the U.S. But if we look at China, for example, they have been very quiet on what's going to happen with Pillar 2. India, also similarly, we have not seen any movement from a Pillar 2. A couple of the bigger economies here in the region, for example, Singapore and Hong Kong, while we're recording this, we're anxiously awaiting Hong Kong's legislation. But both Hong Kong and Singapore have publicly said, well, they are implementing the qualified domestic minimum top-up tax, so a tax on the earnings earned in those particular countries, and they're implementing an income inclusion rule, but neither Singapore nor Hong Kong are implementing the undertax profit rule.
They have wait-and-see approach.
So, of course, the EU, because they've enacted the directive, all the members of the EU have effectively enacted an undertax profit rule. There's some exception for a few EU countries that have less than 12 UPEs in their particular jurisdiction, but for I think it's 23 or 24 that have actually implemented the UTPR. But it seems that cautious governments should be cautious if they're thinking about implementing a digital service tax or implementing a UTPR to see really what happens. Does Trump actually try to invoke Section 891? Does Congress get Section 899 through? Because that bill is through the House, but it still has to go through the Senate before it can go to the president for signature. So I think that'll be a trend as we look at countries that are starting to think about enacting the Pillar 2 rules. Maybe they'll have some second thoughts about implementing the UTPR to try to avoid the wrath of President Trump.
Right. I think with that being said, that doesn't mean that, the country has, like you said, like 30 to 50 countries have already enacted the rule, will stop the rule because the U.S., withdraw from Pillar 2, right?
Yeah, so this is a really important point, Paulson, and I know you get this and I get this as an advisor, is like, does all this going on with Trump mean that Pillar 2 is dead?
No.
And exactly. The answer is no. And I get this question a lot as a U.S. advisor. Well, are U.S. multinationals still getting ready for Pillar 2?
For sure.
Absolutely. They're getting ready. If you have greater, what I tell people as I travel around the globe is that if you're a taxpayer and you have greater than 750 million euro top line revenue, so that's the minimum threshold to be into the Pillar 2 rules, and you operate in any of the 35 countries that implemented Pillar 2 in 2024, or the 50-plus countries that have implemented the rules in 2025, you are still going to have to comply with Pillar 2. Specifically, the qualified domestic minimum top-up taxes, that's effectively like an alternative minimum tax. I know you have an alternative minimum tax here in Taiwan.
Correct.
We call it in the U.S. the corporate alternative minimum tax. Now, of course, the Pillar 2 QDMTT is an entirely different tax base. It's very, very different based on financial accounting principles, and at least with the U.S., there are significant differences in how those taxes operate. But companies are going to have to comply with QDMTTs, even U.S. multinationals.
Right.
And then there's question two with respect to U.S. multinationals. If there's an income inclusion rule, let's say the U.S. obviously does not have Pillar 2 rules, but if they have a holding company, for example, in the UK does have an income inclusion rule and effective in 2024. So as of now, U.S. multinationals are going to have to comply with the income inclusion rule if they have a UK holding company, for example, or any holding company based in the Netherlands. And so the message for taxpayers is you still have to get ready. It is possible that there may be certain carve-outs for U.S. multinationals. I know Trump is advocating for a permanent safe harbor, the Trump administration, for the UTPR. As I mentioned, the UTPR safe harbor currently goes until 2025. It appears that they are also advocating to turn off the UTPR for foreign subsidiaries, maybe via saying guilty as a qualifying regime. Although the OECD had historically said that guilty in its current form should not be a qualifying regime. But really what the U.S. is trying to negotiate and what they've said publicly is they're not advocating for Pillar 2 to go away. What they want is the U.S. system to coexist with Pillar 2.
Right.
And, the U.S. had guilty before there was even such a thing as the income inclusion rule. And on one of my podcasts, Paulson, I had Pascal Saint-Amand, who was at the OECD and the grandfather, if you will, of Pillar 2. He explained that the income inclusion rule was designed after guilty.
Okay.
And then the U.S. has, as I mentioned, a corporate alternative minimum tax, very different from a base perspective, but, analogous to the qualified domestic minimum top-up tax. And then the U.S. also has its base erosion and anti-abuse tax, BEAT, which is arguably similar to the undertax payment rule before it changed from the undertax payment rule to the undertax profit rule. And so as you think about guilty and how it relates to the income inclusion rule, guilty is based on a blended basis. So you kind of accumulate all of the earnings to determine whether there's a top-up tax in the U.S. Pillar 2 is done on a country-by-country basis, but there are some significant differences that make guilty sort of more challenging for taxpayers than even Pillar 2. So, for example, in Pillar 2, there's the substance-based income exclusion that is significantly more generous than what we have related to guilty, which is a qualified business asset, QBI exclusion. And the SBEI in Pillar 2 is much more generous. Plus, the U.S., although the rate is is generally 10%, but we also only offer a foreign tax credit for 80% of any taxes that are paid by CFCs that are subject to guilty. So it really gets it closer to 13.125, and we've already seen the House that has adjusted that number to get it a little bit closer to 14. So it'll be interesting if that number
make sure it's to make it more like in line with 15%.
To make it more in line with 15%.
OECD.
So it'll be interesting to see as that bill progresses through Congress whether the Senate may tweak that a little bit more and whether that gives the OECD kind of permission to say, okay, well, we will treat guilty as a qualifying regime. And if that's the case, then generally the UTPR would be turned off for foreign subsidiaries of U.S. multinationals, and it would also turn off the income inclusion rule. But again, U.S. MNCs would still have to deal with QDMTTs because that is a alternative minimum tax based on a sovereign country's, sourced income.
A lot of things to be discussed continuously, I guess.
Yeah, and I think the other challenge, Paulson, is we love talking about international tax.
I know, we go on and on.
We go on and on. But the elephant in the room is trade and tariffs.
Sure.
Right? And that is really what is driving the bus, so to speak, from a policy perspective. We love talking about international tax, but trade and tariffs is really what is leading the discussion. And obviously the EU plays a oversized role as part of the OECD and inclusive framework. And the EU has publicly said that they are not going to be negotiating Pillar 2. They want those negotiations to take place at the OECD. But what we learned last week, kind of I think shocking to many of us, was President Trump on True Social said that he was going to be imposing additional tariffs on the EU at 50% effective June 1st. And then
out of nowhere.
Right. And then before the weekend even ended, at least here in Asia, and before the Memorial Day in the U.S., he walked that back and said, no, it's not going to be June 1st. It's going to be July 9th, I think. Yeah, July 9th. And listen, if the tax is very important, but from a tariff perspective, it is very possible that the EU could then say, listen, we're not going to negotiate on taxes while we're also being threatened with tariffs. And I think that what's going on from a trade and tariff perspective potentially jeopardizes any agreement that may take place between the OECD and the inclusive framework, including the EU. So I will caution listeners that we think a lot about tax, but really tariff is driving the primary policy discussions. And, it is possible that the EU will say, listen, we're not going to negotiate. If you're going to threaten these tariffs, we're not going to negotiate on taxes. And then we end up with just the rules as they apply today, where the UTPR would expire, the UTPR exception would expire at the end of 2025. And so the UTPR would apply to U.S. parented groups, U.S. base. The UTPR already applies from an enacted legislation perspective this year to foreign subsidiaries of U.S. multinationals. And then presumably Section 899 gets enacted, and we are in a considerable issue for multinationals because we've got both, they'll be fighting a trade war and tariffs, and then we have an international tax war.
Pillar 2 tax war.
And a Pillar 2 tax war.
So
that is not beyond the realm of possibilities.
Yeah, tariff is really becoming the center of the world. I think one fun fact is that my 10-year-old and 8-year-old daughter and son now know tariff in their terminology, and they say, "Dad, is this what you're doing?"
Your kids know trade and tariffs, and my mom knows international tax. It is a strange world that we live in,
It's
Paulson.
a strange world. Okay, let's shift in the gear, considering the time that we have. Obviously, that U.S. currently don't have OECD type of Pillar 2. Obviously, they have their own like IR or BEATS, like you said.
Yep.
And Taiwan, obviously, currently not yet having our Pillar 2 legislation. I know our Ministry of Finance is working on this direction. But I think, can you maybe share your insights, like when you like helping clients over the world? How can they get prepared to comply better on the Pillar 2? And maybe also, like, since you already talk about, like, the tariff and constant changing policy, maybe also speak around that perspective as well. Like, how can companies get better prepared, and what's the most important thing they should be doing?
Well, let's start with Pillar 2. And again, if you're greater than 750 million euro, you operate in any of the jurisdictions, you need to get ready. There are many things that are challenging about Pillar 2, but it is an entirely new tax system and tax base based on financial accounting standards with a number of adjustments. And so effectively what it does is that it requires multinationals that are in scope in Pillar 2 to develop an entirely new set of books. Right. One of the things that we've published is a PwC data input catalog. Mm-hmm. So one of the first things that I did when I took over the role was, okay, what are all the various data points that we need? Because we are building our own Pillar 2 engine to be able to do the compliance. So we need to figure out, well, what are all the data points that are needed to be able to do these Pillar 2 calculations?
Which is massive.
Yeah. So for companies that are in full scope on the rules, we're up to 330 data points per constituent entity that are required. Now, many companies will be able to meet the transitional safe harbor for at least while that exists for 3 years.
Right.
We don't know about permanent safe harbors. I probably should have mentioned that without the U.S. and the OECD coming to some form of agreement, any guidance, additional administrative guidance without the U.S.'s support will not be coming out, so taxpayers won't know what a permanent safe harbor looks like. But even those companies that can meet the transitional safe harbor, it's still a massive data exercise. That data input catalog is available for free on the internet. And what we have found through working with taxpayers is about 50% of that information is in a client's accounting system in an ERP system, which means that 50% of the information is out of system. It may be in consolidation software, it may be in tax provisioning software. There's HR and payroll information that's needed for the substance-based income exclusion. I mean, just a lot of different data points. And so what we recommend for clients and taxpayers is start with a data gap analysis. Figure out, like, do you have the data available? What does your process look like? There's also data that is needed for your country by country report. Most taxpayers that did a country-by-country report did it the following year after the, like it was usually in September when that thing was due the following year.
Right.
If clients are going to rely on the transitional safe harbors, they need to think about, first of all, what data goes into the country-by-country report to make sure that you've got a qualifying country-by-country report. You need to use qualifying financial statements. So generally management accounts or some sort of hybrid accounting isn't allowed. And if you do top-side adjustments and don't push those down in the books, but push those down for the country-by-country report, that can cause your country-by-country report to be disqualifying. And so, what we suggest for taxpayers is due to the data gap analysis, I think many taxpayers know or at least have a sense of what countries they could potentially have to be within the full Pillar 2 rules. So, for example, Ireland has a 12.5% statutory rate. Hong Kong obviously has a territorial system, so even though it's got a 17% statutory rate, many companies in Hong Kong have a below 15% rate. In the U.S., as I mentioned, even though we have a 25% rate because of all of the incentives that we have, it's not uncommon for U.S. companies to be below 15%. Right. So sort of a data gap and an assessment analysis is really important to figure out, okay, what are taxpayers going to need to do as we think about compliance? The Globe Information Return is not due until June of 2026. Right. So I think many taxpayers are like, well, that's a long time away.
We've got some time.
We still have some time. The qualified domestic minimum top-up tax is dependent on the jurisdiction. We know Belgium, Vietnam in region. I think it's Turkey, Liechtenstein. There's a few others that have the QDMTTs that are going to be due in this year in 2025. There's a bunch of registration and notification requirements. Yes. I would encourage folks to check out our Pillar 2 country tracker. We also have all of that available on the internet for free to see exactly when registrations and when tax filings are going to be due. But as companies move from the data risk assessment and understanding where do they potentially owe Pillar 2 top-up tax, starting to think about how are you going to comply and actually get returns filed. The Globe Information Return needs to be done in an XML format. Most taxpayers do not have the technology capabilities to be able to create a Globe Information Return. So thinking about, somebody to partner with to be able to get the Globe Information Return. How are you going to work through the qualified domestic minimum top-up tax returns being filed? One of the things that's interesting, Paulson, about the QDMTTs is about half of the countries that have implemented QDMTTs have chosen to use the local accounting standard for their QDMTT, because generally the OECD said countries could pick whether you use the local accounting standard. Yeah. But about half have chosen the financial accounting standard of the ultimate parent entity. I kind of assume, Paulson, the most jurisdictions would have picked the local accounting standard because that would be significantly easier for them to administer.
For the local.
Yeah, like how a European taxing authority is going to assess a QDMTT based on U.S. GAAP for a U.S. multinational seems to be very challenging.
Right.
But the fact is about half of them picked the local accounting standard, half of them picked the accounting standard of the ultimate parent entity.
Singapore, they use local GAAP. But Vietnam, on the other hand, use UPE GAAP.
Right. So how are the Singapore tax authority, and if there's one thing that I've learned as part of this process, Paulson, is that there are significant differences in these accounting standards.
Definitely.
And IFRS and the US, JGAAP, there's just really big differences that can really swing your Pillar 2 calculations. And so the data gap analysis, identifying who the problem children are, who you may have the top-up tax, and then starting to think about, okay, how do we operationalize and start getting ready and thinking about compliance? Because we are over a year away from the Globe Information Return, but this can take taxpayers months, not weeks, to effectively establish this entirely new set of books and process to be able to comply with the Pillar 2 rules.
Definitely. Okay. I think considering our time, I still like to take one last maybe point and then hear from you, because I think that, like you mentioned, this one big, beautiful bill has caught everybody's attention. And I think a lot of Taiwanese listeners are wondering what that means. Like, can you maybe, on a high-level basis, tell us like what this bill is about, and especially for Taiwanese companies maybe operating in the U.S., what does this bill mean, and what kind of advantage they should be taking considering this bill?
Historically, when Congress has enacted major pieces of legislation, the tax legislation would kind of be separate from spending and expenditure legislation. But what the Trump administration advocated to Congress was kind of put all of this together. That's why they call it one big, beautiful bill.
Right.
And so the tax bill is just one piece of the overall one big, beautiful bill. And that's really obviously what we spend our time with. There's a whole bunch of issues on entitlements and spending related to insurance and other things. But from a tax perspective, for Taiwanese taxpayers that are operating in the U.S., generally the goal of the Trump administration and the Republicans is to effectively take what came out in the Tax Cuts and Jobs Act and bring that back into law and extend that permanently for those that are operating in the U.S., for U.S. businesses. Another important thing to remember is what drives tax policy in the U.S. is not corporate taxation, it's individual taxation.
Okay.
So when the Tax Cuts and Jobs Act was introduced in 2017 and passed in 2018, there are many provisions that expire at the end of 2025, particularly as it relates to individuals. And the Republicans are not going to let those rates go up and on the voters and individual taxes. And so, but there's also a number of provisions that are going to be expiring or that have already expired that probably impact Taiwanese clients or Taiwanese taxpayers. So relevant from a corporate tax perspective, what has been proposed in the House bill, and keep in mind that this has been passed in the House, but then it has to go to the Senate. And so the Senate can make significant changes to these tax rules. We don't know how that's going to play out. But at least the House version generally extended the GILTI and FDII, or foreign derived intangible. So that generally applies for like foreign royalties and foreign exports. They increased the rate very insignificantly, but it's generally close to about 14% after the foreign tax credit. They've extended the BEAT rate. So if there are Taiwanese companies that operate in the U.S. and there are payments coming out of the U.S. that could be subject to the base erosion and anti-abuse tax, that rate was scheduled to move from 10 to 12.5%. And so it will keep that at 10%. What's very important for Taiwanese businesses, particularly given how strong you are in the technology and the semiconductor space, that Section 174, which is the immediate expensing for R&D, that expired several years ago in the U.S. And I know there was hope that Congress may try to retroactively bring that in. I think that is not going to happen. But Section 174, immediate expensing, is included in the bill. Bonus depreciation is included in the bill. The interest limitation rules, which were originally on EBITDA, if you remember, and then they were kind of shrunk to EBIT after a number of years, would go back to EBITDA.
Okay.
So those are all favorable provisions for companies that are operating in the U.S. One of the things that is not in the House bill, but it wouldn't surprise me to see come up in the Senate bill, are some revenue raisers for corporations that are operating in the U.S. There are a number of those, but I think one particularly for Taiwanese or just any foreign multinational, non-U.S. multinational that's operating in the U.S. is we call the sea salt deduction, so the corporate, state, and local tax deduction. Currently, companies that operate in the U.S. get a deduction for the state and local taxes that they pay. There has been some discussion among certain members of Congress that they should take that away. And I mean, effectively, that's
so the tax rate goes up.
Oh, yeah. That's effectively like raising the corporate tax rate without raising the corporate tax rate. So that's something to be very mindful of if the sea salt deduction gets pulled out or gets significantly limited, then companies that operate in the U.S., and this would apply for U.S. multinationals as well as Taiwanese businesses operating in the U.S., that could be something that could cause significant additional U.S. tax. So the way the process works, the bill has been passed through the House. It's now in the Senate. We don't know exactly how long the Senate will take. If the Senate makes significant changes or frankly insignificant changes, what happens is that the bill then goes into this conference, and then they have to reconcile the House bill and the Senate bill, and then it goes back to the Senate and to the House for an up or down vote. And then it would go to the president. It's possible. It's not beyond the realm of possibility that it could fail in either one of the chambers.
So still not very certain.
But what we do know, I think what is certain is that we know that Congress has to enact a tax bill by the end of September because of the way these procedural reconciliation rules work. So even if the one big beautiful bill would fail, I think it is still very likely that a separate tax bill could then come out. And I would be very surprised if Congress is not able to get a tax bill out by the end of September of this year. Again, they need to do that to avoid all of these individual taxes from going up as well as the corporate taxes from going up. So still a lot of uncertainty with respect to corporate provisions and what the actual process will be. But I would very much anticipate that we will see major tax reform legislation really consistent with the Tax Cuts and Jobs Act by the end of September.
Okay. And that means that will be effective next year.
Yeah, with the effective date, generally the effective date being January 1st, 2026 for most of these tax provisions.
Okay. So thank you so much. I think we are running out of time, but I think all the listeners would think that there's so much more we wanted to learn from you. So I'm sure that we will bring Doug back in our podcast again. But really appreciate all the insights that you shared with us.
Well, thank you very much for having me. It was my honor.
All right. 那我想很快的帮大家整理一下今天Doug谈的几个重点哈。那我想一开始我们谈到整个 Pillar 2的进展，那Doug谈到说全世界其实这个不同的国家，但是对于 Pillar 2的很多的问题看法其实是非常雷同的。那另外也谈到这个美国呢，虽然川普总统呢宣布在美国就放弃了这个不跟进这个 Pillar 2，那很多的公司也会询问说这个对于其他国家导入 Pillar 2有什么样的影响啊？我想几个重点，第一个已经立法的国家还是会照着这个立法进程来推进啊这个 Pillar 2，所以并没有影响。那美国呢也透过了这个891的法案，还有就是899的两个法案呢，针对有制定这个 UTPR 这个法案国家呢，来进行一些报复性的这个税制。那现在在这个美国最新的这个 One Big Beautiful Bill 的这个修法里面呢，也把这个899的法案涵盖进来。那也值得我们继续观察，就是这个未来这个899的法案呢，会不会去针对有 UTPR 的国家来进行比较报复性的税制。那我们也谈到说，在这样的环节下，我想对于政府也好，对于这个企业也好，要很关心就是这个 Pillar 2的进展，还有美国现在不管在在关税上面的这些课征啦，还有甚至在 Pillar 2这些报复性课税上的这些动作，对于企业对于政府来讲，在推进这些法令上会有怎么样的一些影响。那我们也谈到对于企业来讲，其实Doug在辅导全世界的企业都看到类似的这样的状况，必须要很积极的去准备，特别是 Pillar 2整个全球最低税负制在这个资料点的收集，谈到每一家公司可能都有超过300多个资料点必须要去收集来计算这个 Pillar 2复杂的这个申报。那也谈到在2025年甚至有很多的国家像是越南啊，那这个像是这个土耳其等等的也都开始要做这个所谓国内最低税负制 QDMTT 的申报，所以要提早来做这个因应跟准备也是非常的重要。那我们也谈到这个 One Big Beautiful Bill 呢，其实是一个复合性的这个修法的法案。那我们预期呢，这个法案呢，当然它不一定会完整的在这个参议院通过但是如果这个没通过的话，有很多在川普第一任任期的这个政策可能会中断，所以也是蛮高的几率会在9月份的时候针对这个法令的内容，可能不是全部也可能是部分来做通过，而会在2026年影响到这个在美国营运的这些公司。那对于台湾企业来讲，当然要去关注这个 One Big Beautiful Bill 里面包括鼓励外商在美国 国境内去投资啊，或者是这个研发相关的这些法令的影响。那另外一个重点就是现在在很多的关税上的协商其实是引领着这个所得税上面的一些协商，所以我想这些很复杂的 policy 现在在各个方面上都互相的影响。那我想今天呢，透过 Doug 全球这个经验上面的分享，可以给各位听众呢很多很深入的一些见解跟看法。感谢您收听今天的税务咖啡厅，希望我们的讨论为您带来了新的启发和实用的见解。如果您喜欢我们这集的节目，别忘了订阅、评分与评论，并分享给更多对税务议题感兴趣的朋友。如果你有任何问题或想要在我们的未来节目探讨的话题，欢迎随时与我们联系。再次感谢您的加入，期待在下一集税务咖啡厅中与您再会。祝您有个美好的一天。